In an environment of slow growth, lower inflation, and new monetary policies, expect 2023 to have an upside for bonds, defensive stocks, and emerging markets. Investors may find themselves a bit whiplashed in 2023 as inflation and some of this year's other dominant market trends fully reverse themselves, according to the 2023 Strategy Outlook from Morgan Stanley Research. So in this video, we are going to tell you that you should invest now for 2023 and 2024. The video is going to be amazing, so make sure you stick to the end. If you've listened to any pundits, analysts, or economists, you know by now that there is a good chance the US economy will tip into a recession either next year or in 2024. How severe that recession will be is anyone's guess. After the Federal Reserve just conducted 4 consecutive 0.75 percentage point interest rate hikes, investors are finding themselves in uncharted waters, especially as the Fed also unwinds its massive balance sheet. That said, investors should prepare for what is to come. Legendary investor Warren Buffett, whose company Berkshire Hathaway has widely outperformed the broader market over the last 7 decades, has seen a recession or two in his day and has the experience many retail investors lack. Buffett likes what he refers to as productive assets like farms and real estate, which are tangible and generate lots of cash. Buffett has also advised people not to make things more complicated than they need to be. For most investors, simply investing in an index fund tied to the S&P 500, which has a track record of performing well long-term, is all they need. Despite some of his more conservative advice, Buffett has always advised investors to look for opportunities during a recession. Be fearful when others are greedy and greedy when others are fearful, the Oracle of Omaha has famously said, and his advice makes sense because all recessions are temporary and have always been, followed by new market highs eventually. Recessions offer investors rare chances to buy stocks when they are at lows and trading at cheap valuations and then reap the long-term rewards. Buffett has followed his advice many times before. Take Bank of America, Berkshire Hathaway's second largest position in its large equities portfolio. Buffett first invested in what is now America's second largest bank by assets in 2011, getting $5 billion of preferred shares and stock warrants, allowing Berkshire to purchase hundreds of millions of shares of Bank of America's common stock at $7.14 per share. Before we move on, support us by hitting subscribe and the bell icon to get notified when we post new videos. Now let's get back to our topic. Cathie Wood is CEO, CIO, and founder of ARK Invest, a closely watched investment fund known for its prescient high-risk, high-reward strategy. Wood was early on Bitcoin and Tesla, and radical transparency. She explains her decisions to buy and sell in a public newsletter. ARK has had a wild ride in the last 2 years. Its flagship innovation ETF was up 150% in 2020, gaining Wood celebrity status, but has been down 38% in the past 12 months. Wood spoke with Time about her long and short-term predictions for the business world and what she has learned from her fund's bumpy ride. Because of all the supply chain issues that we have been facing, businesses might have scrambled a little too much in the last 6 months, and I do think we'll see some inventory issues next year. We're seeing consumption growth in the US has started to disappoint, she continued. Consumer sentiment, as measured by the University of Michigan, has dropped back to a level we last saw at the depths of the coronavirus. I think consumers are upset at inflation and are going to cut back a bit, especially now that their saving rate has dropped to 8%. And then in China, I think that the government's actions are going to slow that economy down more than most economists anticipate. So I think there could be some cyclical concerns next year, Wood said. Overall, investors will need to be more tactical and pay close attention to the economy, legislative and regulatory policy, corporate earnings and valuations, says Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Because we are closer to the end of the cycle at this point, Wilson says, trends for these key variables can zig and zag before the final path is clear. While flexibility is always important to successful investing, it's critical now. In 2023, with interest rates set to decline, conditions bode well for stable and attractive bonds as prices move in the opposite direction of yields. Morgan Stanley fixed income strategists forecast high single-digit returns through the end of 2023 in German bunds, Italian government bonds, BTPs, and European investment-grade bonds, as well as in treasuries, investment-grade bonds, municipal bonds, mortgage-backed securities issued by government-sponsored agencies, and AAA-rated securities in the U.S. However, investors should keep a close eye on quality. U.S. high-yield corporate bonds may look enticing, but they may not be worth the risk during a potentially extended default cycle. For markets, this presents a very different backdrop than 2022, which was marked by resilient growth, high inflation, and hawkish policy, says Andrew Sheets, Chief Cross-Asset Strategist for Morgan Stanley Research. Overall, 2023 will be a good year for income investing. Bonds, the biggest losers of 2022, could be the biggest winners in 2023-2024 as global macro trends temper inflation next year and central banks pause their rate hikes. So that's it. Please like, share, and comment with your thoughts below if you like this video. Remember to subscribe to see our next video. Stay safe, and we will be back soon with another video.